Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all our viewers and friends online. Hello everyone. Today is Thursday, December 18th. This week has already entered its second half, with today and tomorrow left as trading days. I'm very glad to have the opportunity to discuss 2 topics with you all today. The first topic is about Trump boosting the polls. What does his behavior mean? Could his remarks potentially signal upcoming policy benefits or related positive news? In a moment, I'll share some of the latest information with you all. The second topic is about the recently released CPI data, which will likely become a reason for market fluctuations, or for investors to buy or sell. Alright, first let's take a look at our online viewers. Anna, Alice Fu, Huo Shen, and Ernest. Good evening, everyone. Thank you all for tuning in. Let's start with today's introduction. First, let's take a look at the latest developments in the tech industry. Tesla has been accused, though this is just an allegation, not a verdict yet, of potentially misleading people about the self-driving capabilities of its vehicles. Because of this, the California Department of Motor Vehicles may need to take action. The order is that Tesla must suspend car sales in California for 30 days. However, this will only take effect 90 days from now. Just the news coming out first has already caused the stock price to weaken. So what did this agency actually say? He said that Tesla exaggerated the features called autopilot or full self-driving. So he requested that an administrative law judge evaluate whether it's possible to suspend Tesla's driving license or its sales activities. Okay, he mentioned that in 2021 and 2022, there were statements made that were allegedly false or misleading. He said that the advertisements claimed the cars could make short or long trips, even long-distance travel, without any driver operation. In addition, the California Department of Motor Vehicles submitted a revised complaint, stating that regardless of the advertising at the time, or even now, they do not consider these vehicles to be self-driving cars. In other words, they still require human operation throughout the driving process. The driver needs to monitor or observe from the side to see if any abnormalities occur. If there aren't any, the vehicle can probably continue driving, but if there are, then human intervention may be necessary. Otherwise, there could be danger during the driving process. Alright, so next comes a lengthy regulatory process, and it's even possible that there will be an appeal specifically regarding this point. So Tesla's stock price was a bit weaker yesterday, and this also dragged down the broader market a bit. But its stock price fell by 4.62%, and honestly, I think in terms of reflecting this news, it's actually pretty neutral. Not exaggerated, but also not a contrarian rise. Basically, the strength or weakness of this news is about at this level. Because actually right now, as I mentioned to everyone yesterday, you can't buy SpaceX at the moment. SpaceX will only start its IPO next year, so the investment options that people can access are actually quite limited. If you really want to buy something related to Musk besides Tesla, there probably aren't any better options. So that's the reason for the recent market movement. Alright, let's take a look. Yesterday, the Dow Jones Index dropped by 0.47%. Among the 3 major indexes, it's considered one of the stronger and more stable ones. Let's take a look inside. Chevron, Caterpillar, and McDonald's. Some of these more traditional industries performed relatively well yesterday. On the other hand, among the weaker performers, there are some related to AI. For example, Caterpillar, which previously was rumored to be developing some AI-related products and stepping into related applications. It seems like the response was a bit lackluster. Now, let's take a look at the S&P. Among the 3 major indexes, the S&P 500, which is also a key indicator, dropped by 1.16% yesterday. Now, the index has come close to the 50-day moving average, which makes today a great day to observe. Why? Because today we need to see how the index behaves at this level. Compared to the record highs we saw last week, the current trend is definitely a bit weaker. Investors are also starting to worry that if on top of everything, the Bank of Japan potentially raises interest rates tomorrow, or if their statements aren't as dovish, could that trigger or lead to further selling pressure? So investors are paying close attention to this key point, and we'll take a look at it together in a bit. especially the recently weaker semiconductor sector, but the S&P 500 is still trading between its 50-day and 100-day moving averages. Alright, we'll take a look at that shortly, and here are its component stocks. Among them, the stronger ones are the oil-related stocks. You can see that the top few are all energy and oil companies, which are traditional energy sectors. On the other hand, the ones performing worse are of course those that have been more controversial recently. For example, we can see Oracle, Supermicro, NRG, Constellation Energy. These are all actually related to AI and can be considered as having the same or similar themes. Recently, they've been affected by the sector rotation or by some of the recent news and charts. There have been ongoing voices talking about a bubble, but do these claims of a bubble really mean that there will be a significant impact on their long-term profitability or outlook, or that all these doubts about their profits will actually create a long-term structural headwind? That's not necessarily the case. As I've analyzed before, whether you look at it from the perspective of profit forecasts or from revenue and business operations, in the short term, yes, there might be some impact and selling pressure. But in the medium to long term, the bullish development and the industry structure haven't really changed much. There hasn't been much change or shift. Similarly, if we look at the Nasdaq 100, yesterday it was the same. It dropped by 1.93%, which is close to the 100-day moving average, and that's a bit... Today is a very good indicator, because there are only 2 trading days left this week, right? If we see another drop today, then it might touch the 100-day moving average. But if it starts to stabilize, maybe it could be like last time. At a certain point, it just stopped falling. Alright, let's take another look. Among the Nasdaq 100 components, the best performers are XOM, Chevron, Gilead, Comcast, and Adobe. They're relatively at the top. So as investors, you'll definitely look for opportunities among these, maybe focusing on stocks or companies you already keep an eye on. If you notice certain features in the earnings reports that you personally like, or if you see indicators in the buying and selling momentum that you find suitable or easy to work with, you can further observe their intraday performance after the market opens, especially after 10:30. Because if we look at tomorrow, it's close to the weekend, and next week we're facing the Christmas holiday situation. Maybe some institutions or fund investors might engage in some profit taking, or they might want to close out their positions for today or tomorrow, thinking that they can do some short-term moves to manage or reduce risk. Control it, or at least make it less obvious. Lower it a bit, so there will be some profit taking, which is completely normal. So, like I mentioned yesterday, if you're really worried about tomorrow's Bank of Japan rate hike, or whether their statement will continue to follow this tightening path, if you're really worried and concerned about potential selling pressure, then you should adjust your positions in advance. Alright, let's take a look. Among them, the Nasdaq 100 performed relatively weaker. We see companies like K2A, Strategy Company, Broadcom, Tesla, and as just mentioned, Lam Research. AMD in comparison is also related to semiconductors, but none of these have dropped more than 10%. Relatively speaking, the declines are still within a controllable range, and there's no sign of panic. Alright, next, we'll break things down for everyone, one by one. First, as you can see, this is the second time this week we're showing the historical index, and this time the time span is a bit longer. Why is that? Because we can see data from the past 2 years, that is, from the beginning of 2024 up to now, of course, during this year's tariff adjustment period, AVIS. It shot up for about 4 or 5 days, going above 50, but right after that, it quickly pulled back, which means the index started to stop falling and rebound. Here, we're talking about the S&P 500, because this is the volatility index relative to the S&P 500. Alright, so the previous time was in 2024, between August 1st and August 5th, when it started to surge rapidly. At that time, besides the Bank of Japan raising interest rates, there was also the impact of US economic data. There were concerns about a hard landing for the economy, and even some other negative news came out. At that time, the index even went above 60, but it ended within a very short period, just a day or two. That is, it started to stop falling and began to rebound. So what about the latest miss recently? After yesterday's drop in the index, it went up by 6.92%, which means the index is now around 17.62. For the current period, this isn't an especially high index, because as we mentioned on Monday and Tuesday, when it was around 26 or 25, that was a recent peak in terms of volatility. So right now, actually, the calculation is still okay. It hasn't reached the point where the pressure is extremely high, causing volatility to spike sharply. Now, let's look at today's first topic. Trump started giving a speech this morning. And actually, it's pretty simple. The content of his speech is just this. He spoke to his voters, or rather to the American public, telling them what good things have been accomplished over the past 11 months. He also mentioned that there will be special holiday bonuses given to the military soon. He even plans to introduce housing-related reform measures in the coming year. The main goal here is to control what people perceive as inflation, whether it's in food or other areas. Food prices, for example, have already started to gradually decrease, and if he can also manage to keep housing prices under control, there could be further reforms. Don't forget, after all, he actually started out in the real estate business, so he has a wealth of experience in the real estate industry. Alright, so here it says that he also used this speech to promote his achievements in his first year back in the White House. This is already his second term. He hopes to convince voters that even though people are still anxious about the economy, that should be blamed on Biden. He said that Biden left behind a mess, and now he is cleaning it up. He also mentioned that what lies ahead is the best America ever. This is very much in line with his usual rhetoric. Of course, Trump has always had this kind of heroism about him. He tends to take a lot of the attacks upon himself, which is quite normal because that's just his personality, and in some cases he might not be wrong. For example, when he imposed high tariffs, if you look at it purely from the perspective of Americans and not from the viewpoint of other countries, then perhaps this is one of his notable achievements in trade. If you look at it from the perspective of generating revenue, it makes sense. Alright, let's take a look at real estate developers. Are there any new updates or news about the industry around here? Recently, in December, there was a slight increase. This is information about real estate developers. They have continued to use favorable sales conditions and stimulus policies to encourage buyers to enter the market, whether it's for purchasing new homes. We can see that Wells Fargo and the National Association of Home Builders, NAHB, jointly released a Market Conditions Index. In December, it rose slightly to 39, which is the highest since April this year. Back in April, it was due to tariff issues. Now, although 39 still hasn't crossed the threshold of 50, which is considered the dividing line, looking at the current short-term trend, although it's relatively optimistic, on the other hand, we see that mortgage rates are hovering between 6.3% and 6.4%. For those of us in Asia, like in Taiwan, it might be hard to imagine mortgage rates being this high. Because for most people, even 2 or 3% already feels high. It's already considered something that the average person might not be able to afford. But this is the United States, and things are a bit different here. A rate of 6.3 or 6.4% is actually close to a one-year low for them. So to a certain extent, this has encouraged some buyers to go ahead and make a purchase decision. In other words, those who were previously on the fence now feel that this rate is something they can afford, or it's made them decide they want to buy a house. Alright, let's take a look at real estate related ETFs. Here, we're talking about the ETF with the ticker symbol VNQ. As of now, it closed yesterday with a slight increase of 0.37%, which means there is some capital flowing in. Some funds have moved into different sectors for hedging purposes, which can be considered sector rotation. As everyone knows, the main source of selling pressure actually comes from technology and chip-related stocks. As for other traditional sectors, or those less connected to the tech cycle, the impact hasn't been as severe. Alright, let's take a look at some of the main constituent stocks within it, starting with those with the largest weights. Since this is an index that's closely tied to the overall market, let's look at individual companies. For example, Well, 24+, PLD, and even Ant, as well as American Tower, and other real estate or economic cycle related companies like these. Okay, and if we look further up the list, there are CCI, Crown Castle, and Public Storage, PSA. Today, let's take a look from a slightly different perspective. Alright, first let's take a look at CCI, Crown Castle's profit forecasts. Its earnings per share, or EPS, as we can see, is denominated in US dollars. Starting from 2025, even in the first quarter of 2025, it's actually negative, but by the second and third quarters, it gradually stabilizes. In 2026, it remains positive, and by 2027, it starts to pick up momentum. So actually, as we discussed a couple of days ago, in a cycle like this, say for example an interest rate cut cycle, real estate is one of the industries that could relatively benefit. Plus, if Trump really follows through on what he says and is planning related measures as he claims, that would also be favorable for real estate. With this kind of positive factor, it's worth looking forward to whether there will be a new policy like this in the future to further stimulate stock prices. So today, we'll start by looking at sectors that don't have such a high proportion. For example, yesterday, it went up by 0.4%. We can see from the chart that it's currently at a relatively low level. For example, back in July, the stock price even went above 110 yuan at one point. So pay attention to how things develop over the next couple of days. Of course, further investigation is still needed. Now, moving on to public storage, PSA, we can see that its profit forecasts starting from 2025 are actually quite stable. The earnings per quarter go from just over $1 to nearly $2, and even above $2. By 2026 and 2027, each quarter is expected to have earnings of over $2. In fact, on a yearly basis, it's expected to be over $10 each year, so this is definitely something worth paying attention to. Looking at its performance, yesterday had a slight drop of 0.12%. Compared to the price it reached in October, which was over $310, it's now around $267.17. So compared to before, it's already trading at a bit of a discount, meaning it's not at such a high level anymore. Let's take a look at some important financial events and economic data. Later, we'll have the CPI, and on Friday, there's the University of Michigan consumer sentiment and short and medium-term inflation expectations. When we talk about the CPI, actually this is although some people in the market think it's pretty important, actually the most important event this week, the non-farm payrolls, has already passed. As for the CPI and prices, at this point, they're not the Federal Reserve's top priority anymore. They'll still keep an eye on it, but right now they're more focused on the employment situation. That is, whether employment is actually as weak as previously estimated. Maybe they've really underestimated the weakness in job growth, meaning the job market is actually pretty sluggish, but the Fed doesn't seem to think it's that bad. This could cause them to remain cautious and move slowly when making decisions about interest rates. Why do I mention this? Because the members of the Federal Reserve Board are all highly trained, whether they're PhDs or policymaking experts, so before they make any decisions, they have to be absolutely sure they're making the right call. They're not afraid of being late. What matters to them is being right. But because of this, sometimes they might miss out on certain opportunities. Plus, policy itself actually has a lag. Generally speaking, when it comes to interest rate policy affecting the real economy, there's usually a lag period of about 12 to 18 months. In other words, these last 3 rate cuts may actually take more than a year before we see whether they can really ease or loosen things up for businesses or the credit environment. Right now, when we talk about the current economic situation, it still takes about 12 to 18 months for the effects of those interest rate decisions to gradually filter through. As for today's CPI, the market is expecting a positive 3.1%. Let me introduce a few scenarios here to make some projections. If, let's say, it doesn't turn out to be extremely exaggerated, let's just assume it's above 3.5%. If it's above 3.5%, then a more obvious price pressure will show up. If it's between 3.1 and 3.5%, maybe we'll see some range-bound fluctuations, possibly within plus or minus 0.3 to 0.5%, something like that. But if it moves more toward below 2.8%, or if we suddenly see some odd numbers like 2.5 or 2.7%, or if people feel there's a clear drop, then the market rebound could be even bigger. So that's the result of today's CPI, which is steering the direction of buying and selling. It could also serve as a new narrative for investment institutions or American investors regarding the Fed's next moves. In other words, they might think the Fed doesn't need to focus so much on prices anymore and should quickly shift its attention to the job market instead. All right, let's take a look at what risk factors lie ahead. Actually, this is one of the conclusions from an industry report, which says that the main risks are about timing and investment returns. If the adoption rate of artificial intelligence ends up being slower than expected, in other words, even though AI applications are currently developing at a rapid pace and gradually booming worldwide, if this speed turns out to be slower or lower than what market analysts and investment experts have predicted, or if another situation arises, if tech giants, due to intensified competition, end up disappointing people with their pricing power. For example, when only ChatGPT was available and it had just launched its subscription service, everyone was eager to subscribe. But if today there are many options, with other products performing just as well or almost as well as it does, then companies will probably start competing on price. Another example is the use of tokens. Or maybe it's about the multimodal capabilities it offers. For example, if I can upload a document or a video, or if it can generate images or videos, these kinds of features, then each company in the market will start to show its own unique differences. If there aren't enough participants, then there might also be some price wars. In other words, maybe today I need to pay $10 a month, but some might only charge $8, some $6, or even as low as $2, or even offer it for free. In this kind of situation, what we call pricing power might end up disappointing people because everyone is competing with each other. So even though these are already the industry leaders, right now it looks like Gemini and GPT, the question is, how long can they keep it up? And what kind of profits can they develop in the future? That's something we'll have to keep watching. Here, it's mentioned that profit forecasts might be significantly revised downward, but I think this adjustment is probably because, in fact, OpenAI hasn't gone public yet. So a lot of the data isn't really transparent, and people aren't very clear about what's actually going on inside, whether it's gross profit, net profit, or other aspects. What exactly is their financial structure like? On the other hand, the market is questioning. If these profits haven't really materialized yet, and the actual performance is still very minimal or even negative, in other words, if they're still operating at a loss, then has capital expenditure already peaked? In the next year or two, will we still see those so-called hundreds of billions of dollars being spent to build data centers, purchase computing power, or rent computing power? So could it be that we've already reached the peak in this area? In other words, has capital expenditure actually become excessive? These are all concerns people have. But considering that AI-related stocks now have extremely high weightings in the major indices, as we just mentioned, you can see that the top large cap stocks, like Nvidia and Broadcom, for example, are leading the way. Big companies, those related to chips, even TSMC, Taiwan Semiconductor, is included in the semiconductor index and is considered a highly influential company. So for this theme, even if there's a partial reassessment, meaning within these themes and indices, let's say a fund company originally allocated, say, 40 or 50% to the tech sector or to chips, once everyone starts to lower their allocations, say down to 38 or 35%, it could lead to capital outflows or even selling pressure. He said that even in such a scenario, this could still happen. Let's look at the broader impact. For example, the Philadelphia Semiconductor Index was actually the biggest loser among the 4 major indices yesterday, dropping 3.78%. So some investors are worried about this recent decline. Will this happen again? Will it be a repeat of what happened before? You see, after it broke below the 50-day moving average, it only gradually started to stabilize. But right now, things look pretty uncertain. Why is that? Because if we look at it, not just from the previous day, but even from last Friday, you can clearly see that the decline started from last Friday. That was the starting point of this downward trend. Previously, everything else was even hitting new highs, but as of yesterday, selling pressure started to emerge. So let's take a look. Actually, if you check the major indices before the market opened, or important stocks like Micron, they were actually up in pre-market trading. So with the market going up, it could potentially revive some bullish confidence. In other words, whether it will drop that badly after this is still uncertain. We can't immediately say that it's definitely going to fall next. Just because it dropped yesterday doesn't mean it will definitely drop today. Alright, let's take another look. If we consider this situation, if the market crashes and stays down for the whole week, what will happen next? Here, we have data from nearly the past 10 years, from 2016 to 2025, showing this kind of situation. There have been 4 times when this indicator appeared. Why don't we go back to the previous page? Looking at the previous page, if we take last week's high of 7,490.277 and compare it to yesterday's closing at 6,695.30, I did a quick calculation and the drop is about 10.61%. But this 10.61% is calculated from the highest point down, so it's not entirely. It doesn't necessarily meet all 4 criteria of this so-called indicator yet, so it's not certain. But let's just assume for now that it does meet the criteria. Then the signal should light up in the next couple of days. But that's okay. Let's take a look at the previous 4 instances above and see what happened afterward. First, we can see that in 2020, there was a drop of more than 10%. Here, what we're looking at is the SOX, which is the Philadelphia Semiconductor Index. After it dropped by 10%, it gradually started to rebound upward. Alright, next, let's look at the second time. After the index dropped that week, it then fluctuated and moved upward. This rebound wasn't as strong as in 2020. As for the most recent time, after the index dropped 10% that week due to the tariff issue, I think everyone is pretty clear about what happened afterward. Was there ever an exception to the continued strong rebound? Out of the 4 times, what was the only exception? It was at the beginning of 2022. After the index dropped sharply, in the following few months, it continued to decline slowly, basically moving sideways to down. What was the variable at that time? It was the aggressive rate hikes, the hawkish rate hikes, with several consecutive increases, and all happening very rapidly. So we need to ask ourselves, right now, is the Fed in a rate hiking cycle or a rate cutting cycle? Everyone should know the answer to that, right? Obviously, if there are rate cuts after the market keeps taking this miracle cure, it should have a soothing effect on the stock market. Okay, let's take a look at international stock markets and investment news. After years of rapid expansion, the solar industry has gradually entered a phase of low growth. It's expected that in 2026, the industry will see its lowest growth rate in 7 years. The newly installed solar capacity in 2026, that is, the installation of solar panels and related solar power systems, is projected to, compared to 2025, this will be the first decline since Bloomberg New Energy Finance began tracking the solar industry over 20 years ago. So their outlook here is actually relatively conservative. They mentioned 2 reasons. First, policy shifts in both China and the United States have led to a cooling in their respective domestic markets. Moreover, some mature markets are starting to reach saturation, so the growth trend and momentum are no longer as strong or obvious. Let's look at this from another perspective. From the perspective of senior executives in the solar industry, they point out that although the growth rate of solar power generation in China will slow down by 2026, China still has the potential to expand its solar power generation capacity in the coming years. They also mention that solar power accounts for more than 60% of newly installed capacity. He said, "We predict that in another 2 or 3 years, solar energy will become the largest energy source." This is what the deputy director of Sunshine Energy stated. That's right, the direction of US policy, ever since Trump was elected and even after he took office, has actually already, relatively speaking, clean energy is no longer being prioritized. So if that's the case, what about solar energy stocks, or the major companies in the sector? Shouldn't their stock prices be on a steady decline? Let's take a look. This is the solar-related ETF, TAN, which is managed by Invesco. You can see that since June or July, it has continued to trend upward and hit new highs, and only recently has it started to consolidate a bit. It was only in November and December that this kind of trend started to appear. As for yesterday, it dropped by 1.13%. Let's take a look at the main holdings of this solar-related ETF. First, we have NextEra Energy with the ticker symbol NXT, which makes up more than a certain percentage of the ETF. Another major holding is First Solar. FSLR accounts for more than 10%. As for the others, relatively speaking, their proportions aren't as high, but there are still some with 5% each, like Sunrun or Enphase. So here you have RUN and ENPH. Moving on, the ones further down the list have relatively smaller weightings. Now let's take a look at Bloomberg's list of profitable stocks. Earlier, we saw that the largest holding is also NextEra Energy. Looking at the earnings estimates from Bloomberg, in 2025, the first 2 quarters are projected at 0.93 and 0.97, and by quarter 3 and quarter 4, the numbers rise between 1.03 and 1.29. If we continue to project into 2026 and 2027, what will the numbers look like? It can gradually stabilize, with each quarter earning more than $1, and even showing growth quarter by quarter. For example, each year it could potentially earn between $4 and $5 or more. This is the current mainstream forecast for it on Wall Street. As for NSST, it closed down 2.47% yesterday. Since June or July, its price has actually been rising slowly. This has been the trend for its stock price in the past. Alright, next, let's look at First Solar, ticker symbol SLLR. In terms of its earnings forecasts, we can see a pretty clear situation, a noticeable change. From 2025 onwards, the estimates are 1.95, then 3.18, 4.4, 4.24, and 5.29. By 2026, the estimates start at 4.44, then 5.28, 6.04, and 7.02. But all these numbers in black are still just projections. The blue ones are actual results. So looking ahead, this is really Wall Street's, or rather the mainstream investment institutions' outlook on the company. Overall, their view was relatively optimistic. By 2027, they're even estimating quarterly earnings of 6.09, 7.59, and 8.27. That means in a year, it could even reach an earnings level of $22 to over $28. Alright, let's take a look at its stock price. Yesterday, it dropped by 1.73%, and right now, the stock price is around $254. We can see the issue that Zhao just mentioned. If Trump's policies in the US continue, and solar energy isn't really a focus of his administration, then theoretically the stock should go down. But is that actually what's happening with the real stock chart? Not at all. Since the second half of the year, it's actually been going up steadily, so everyone can observe and try to figure out why, or even look for answers within the industry themselves. Alright, let's look at this week's company earnings reports. Today we have MU and Accenture, and tomorrow it's Nike and FedEx. Alright, let's take a look at what happened after the market closed early this morning. Micron released its earnings report. Since it's a leading stock in the currently hot memory chip industry, not just a concept stock, but a true bellwether, it's a very important company. Relatively speaking, it released a very optimistic revenue outlook. According to the after-hours earnings announcement, the latest quarter's revenue is expected to be between $18.3 billion and $19.1 billion. This is higher than analysts' average estimate of $14.4 billion. Even the EPS reached $8.22 to $8.62, which is much higher than the forecasted $4.71. Wow, that's a huge difference. And the stock was also trending upward in pre-market trading. All right, let's take a look. This was yesterday's closing price, which dropped by 3.01%, closing at around 25.52. That's roughly near the 50-day moving average level. Now, let's take a look at international stock markets and investment news. So, companies like OpenAI and Anthropic, which are developing large AI language models, are also seeking to expand their office presence in Dublin, Ireland, which is a very important country within the EU. The growing influence of these two companies in Europe also reflects their role in accelerating the global competition in artificial intelligence. Oh, and actually, aside from these two companies, of course, Google Gemini has also been very popular lately. Besides that, there's also a company called Mistral, which is headquartered in Paris, France. Oh, and actually, it's relatively well liked in Europe. Why? Because its main language is in English. But for example, with German, French, or Spanish, its usage and reputation are quite good in Europe. If you're interested, you can try it out yourself. See if you can ask it some questions that you think are pretty complex. Or you could use Google Translate to turn your Chinese into German first, and then use German to ask it questions. That works too. Then translate it back. You can use a lot of different ways to test it and further explore how to use it. See how well it performs. Alright, now let's take a look at the pre-market gainers and losers in the US stock market. First, we can see that Micron Technology is the strongest performer in the pre-market. Other stocks like SanDisk and related storage concept stocks are also notable. Then there's Lululemon, up 5.58 in pre-market trading. Of course, this is the situation as of a little after 6. After that, before 10:30 in the pre-market, everyone should double check for updates themselves. As for the decliners, PayPal is one of them. It's down by a little over 1%. Alright, let's take a look at its pre-market information. The reason is that its recent trend, what trend is continuing, is that the growth rate over the past few quarters has started to slow down. So it's facing fierce competition from some up-and-coming brands or low-cost retailers like Yoga or similar new brands. As a result, it might have to, for example, introduce a lot more discounts to attract consumers to buy its products. So its sales growth has already dropped to the lowest level since it went public in 2007. In fact, why did it have such positive news before the market opened recently? It's because this aggressive investment firm, Leo Investment Management. As for the film company, actually the way it used to operate was, they would buy shares in a company they find interesting. Maybe a company facing some short-term crises or operational difficulties. Or perhaps they simply don't agree with the company's recent management practices or market strategy. They would get involved by continuously buying up its shares, and after acquiring those shares, they might put pressure on the management team, for example, suggesting what strategies to adopt or what kinds of reforms to implement. The goal isn't necessarily to bring the company back from the dead, but rather to keep improving it until they're satisfied. Of course, this could lead to a rise in the stock price or an improvement in the company's performance, which is why they're considered a more aggressive type of investor. Alright, let's take a look. The latest CPI. November's CPI is 2.7. Yeah, that's definitely a strange number. Okay, so there are a few things to keep an eye on, especially after the market opens at 10:30. Alright, that's all for today's Quinny. Good night. I'm very happy, and I wish all investors smooth trading and lots of profits in the next 2 trading days. See you tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.